Welcome to the Purpose-Based Retirement with certified financial planner Casey Weade. Casey is the president of Howard Bailey Financial.
Whatever risk you face during your retirement years, we've got a plan.
A published author and radio host.
It's not how much we make during the good times, it's how much we keep during those really bad times.
His advocacy for retirees and pre-retirees has made him a sought-after speaker and trusted financial leader.
And putting a real plan together.
This is the Purpose-Based Retirement.
Good to see you again. Thank you for joining us. I'm Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're going to start our program today by taking a look at an expense that none of us want to face, but we all need to be aware of, and that is, how are we going to pay for long-term care in retirement? Are you going to leave the cost of nursing home care to your children? No, of course you don't want to do that. We'll take a look at some options. And then we're going to hear later from a caller who has a question about, after being self-employed for so long, they feel like they might be behind the eight ball on Social Security. What can they do to help themselves in that way? So we have a lot to talk about today, but Casey, I do want to start with that important issue of long-term care insurance. None of us want to think about $70,000, $80,000 a year for nursing home care and retirement, and yet you say paying for long-term care insurance actually helps you enjoy retirement. Help me think through that.
You know, and I found this to be very true with almost everyone that I've ever worked with, and especially people that walk in and they already have some type of long-term care coverage, because quite often I'll say, why aren't we spending more out of this nest egg? You have to ask yourself that. Why am I not spending more of my retirement? And many times what I hear is, well, I'm trying to preserve the principal, or I'm trying not to spend as much, or I want it to grow so that I can someday use it for health care if we have a major health care problem in the future. Imagine being able to spend those dollars with confidence, knowing that irregardless of whether you spend a little bit of the principal or it doesn't grow over the next 10, 20, or 30 years, that you're going to have that need covered. That allows you to go into retirement knowing that you've got all your bases covered, and that's really what a purpose-based retirement's all about. It's about covering each one of those potential risks you have during your retirement years so you can spend with confidence and enjoy your retirement like you deserve.
So let's very quickly here just touch base on, what is long-term care insurance meant to do for me?
Well, long-term care insurance is meant to take care of those things that your short-term health care insurance doesn't take care of. You know, we all have that short-term care that'll pay for your doctor's visits or your hospital visits, but if that visit extends beyond 30 or 60 days, as in the case of Medicare, now you're on your own. Now you have to start spending dollars out of your own pocket. Your traditional health insurance, Medicare supplements aren't going to cover you for that need, and that's one of those common misconceptions. We go, oh, well, I've got health insurance, I'm perfectly fine. That's only going to take care of those short-term health care needs. Once it extends beyond that, and that could be home health care, that could be assisted living care, that could be nursing home care, and I should say scare, right? The dreaded nursing home, skilled nursing home care that nobody wants to go to. But nobody wants their house to burn down, nobody wants to get in a car accident, but we have coverage to make sure that we're not left destitute, or more importantly, we don't leave our loved ones destitute during those types of circumstances.
Well, but I don't like the thought of paying for all that long-term care insurance, and then if I pass away and I never use it, it's that use it or lose it scenario that's not very attractive to me.
Well, and that's led to a huge decline, just one of the many things that's led to a huge decline in the use of traditional long-term care insurance. And traditional long-term care insurance charges you a premium. If you're, say, 60 years old, it could be $2,000 a year, it could be $10,000 a year. It just depends on how much coverage that you want and how you want that coverage actually to be structured. But you know, those traditional long-term care insurance policies peaked back around 2000. In the year 2000, Investment News recently put out an article that showed in the year 2000, 750,000 traditional long-term care policies were sold. Now, as we've seen interest rates continue to decline and people live longer lives, that's put more and more pressure on these insurance companies, and they've also increased their premiums quite dramatically. And what we've found is in the year 2015, only around 100,000 long-term care policies were sold, while there were over 200,000 hybrid long-term care policies sold. And just in 2007, there were only 5,000 hybrid long-term care policies sold. So what we're seeing today is about twice as many of these combination policies or hybrid policies be sold over traditional. And part of that is because people don't like that use it or lose it nature of traditional long-term care insurance. This gives you the ability to either use an asset and has some type of growth attached to that cash or that deposit. So there's usually some type of cash value that allows you to have back your original investment, typically of some type of growth, and has a long-term care component to it. If we ever need long-term care coverage, it'll pay X amount of dollars every month. And if we never use it, there's a tax-free death benefit that passes on to our heirs. And most importantly, I think the premiums are fixed. They're not going to increase like you see traditional long-term care policies increase, with some increases over the last couple of years being as much as 126%. And that's something that I think the people I work with, they don't want to see their premiums double over the next 10 years or the next 5 years for that matter. And I don't want to be in that position either as the advisor that told them to go down that path.
So if you are one of those folks who really haven't thought through exactly what you're going to do and how you're going to insulate your family from the risk of long-term care insurance, here's a good way to find out exactly what options might be available to you is talking to an advisor. And the opportunity we have for you right now is for our next 10 callers who phone us right now, we're offering a complimentary financial review of your entire financial and retirement plan. It's an opportunity to give you an education about your money so you can make the best decisions moving forward. So for the next 10 callers, Casey and the Howard Bailey team will make time on their calendar to sit down and visit with you and give you your very own purpose-based retirement. When we come back, questions from our viewers. Stay tuned.
Hi, I'm Casey Weade, a certified financial planner practitioner and the president of Howard Bailey Financial. Do you feel that your financial professional should put your interests above all else? Well, I do, but Wall Street doesn't. While lobbyists seek to delay a universal fiduciary duty on all retirement accounts across the financial services industry, you can begin working with an advisory team that's ahead of the curve. Don't you want to work with someone who puts your interests ahead of their own? If you said yes, then give us a call today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts Casey Weade and Marshall Johnson every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
And welcome back. During the week, people drop Casey an email with a question or two. We pick out the best of those and invite those callers onto the program, and that's what we're doing today. So Larry is with us today with a question. Go right ahead, Larry.
My wife and I have most of our money in IRAs and are approaching age 70. My accountant says I'm going to be forced to take annual distributions, but we don't really need the money. He has suggested moving the funds into a brokerage account. Is this my only option?
Well, Larry, it's not your only option, but it probably is the most popular option. And it's probably the most obvious one. Well, we get that distribution after we get to the age 70 and a half, and they start forcing us to take distributions from our IRAs, pay taxes on those dollars, and then we say, well, what are we going to do with this money? And your broker says, well, why don't you put it back in these A-share mutual funds or put it back in this investment portfolio and we can continue investing. And that's perfectly fine. It just depends on what you're trying to accomplish with those funds over the long haul. There's a lot of different options and it depends on your own given situation. One of the things that we've talked about here on the show in the past is something that was put into law back in 2006, and it was temporary back in 2006, called Qualified Charitable Contributions, or IRA distributions. And that allows you to take that required minimum distribution and send it directly to a qualified charity and get a 100% deduction for that contribution. And that could be your church. So if you tithe, that can be a great opportunity for you to get 100% distribution or a deduction versus taking it into your hands and then getting a proportionate deduction when you do your tithing. So that's one of the options if you're charitably inclined. If you're not, then there are some other things that you might want to consider. One being, I've got a gentleman that recently came to me and he had the same issue. And he wasn't spending his retirement. He said, we don't need this RMD, and really the whole plan here here is to leave these funds behind to our heirs. And so we took about $10,000 a year of his required minimum distribution. We could have put that into a brokerage account. He would have still had access to the funds, easy to access. But what we decided to do was move that into a life insurance policy that guaranteed a $550,000 death benefit to his heirs. He was just turning 70 years old. So at the time, they were 68, 69. We were able to take $10,000, turn it immediately into $550,000 tax-free for the heirs. And that guarantees them a double-digit tax-free rate of return at their life expectancy. And that became a great solution for him. Now, if this is going to be your emergency fund, this might be the idea for you to put it back into your brokerage account and put it into conservative ETFs or low-cost ETFs or low-cost managed accounts. So there's a lot of different options. It just depends. Is that your emergency money? Is it for long-term care? Is it for legacy? There's a lot of things for you to consider. And one of those things, since you're not 70 yet, is considering a Roth conversion.
Thanks a lot, Larry. We're going to move ahead to Kate, a business owner with a question about maximizing Social Security. Go ahead, Kate.
My husband and I have owned our own business for most of our lives, and there have been some unintended consequences when it comes to our Social Security benefits because we haven't taken normal W-2 wages. We have been told to increase our W-2 wages over the next couple years before retirement because they count more towards our retirement benefits. What are your thoughts?
Well, Kate, thank you for your question. And this is a problem that a lot of small, medium-sized business owners have, is that they get that income from the business and largely take it in the form of dividends or distributions from that corporation, and they have a relatively small W-2 wage base, and that results in them not paying as much in Social Security taxes. Side consequence is our Social Security benefits are much smaller. And Kate, in your instance, if you're only a couple years from retirement, you're going to have a very minimal increase in those benefits by taking a larger salary and paying a little bit more in taxes over the next couple of years, because I think it's important for you to understand how Social Security benefits are actually calculated and what they're based on. They're based on your highest 35 years. And they also adjust that for inflation. So your highest 35 inflation-adjusted wage earning years are then used in a calculation to create that Social Security benefit that you're going to receive. And so imagine this, we have 33 zeros and two $100,000 numbers that go into that average. It's still going to be a very small number, and those 2 years out of 35 are going to have a very small impact. I would argue that you're probably better off saving the money in the taxes and putting that someplace where you know you can use it for retirement. Put that in a retirement savings vehicle that helps you save some money in taxes today, and use that tax savings to add into that retirement that you're going to have so that you can actually use those retirement dollars. And again, you know you have them in your hands. Mm-hmm. We don't know exactly what the changes of Social Security will look like over the next 30 years.
Well, isn't that the truth? Let's jump out, I think, to Huntington and Dayona with your question for Casey. Go right ahead, Dayona.
Hi, my advisor charges 1% per year to manage my portfolio, but I don't feel like I'm getting that much bang for my buck. What is a fair advisory fee, and when does it make sense to pay it?
Well, Dayona, this is a question that I think everybody should be asking. Nobody's asking it, but everybody should be asking, what am I paying my advisor and what am I really getting in return? But nobody asks this question. So first of all, spectacular job actually being concerned about the fees and expenses that you're paying. And I think a good example of this, because I often say young people don't necessarily need a financial advisor. Young people need to be dollar cost averaging in index funds and maximizing that retirement and minimizing their expenses. I had a young couple that I met not all that long ago, because this is all about the value that you're actually getting for that 1%. So I had a couple that I met here recently, a couple of teachers, and they were in their 40s and late 30s. They weren't going to retire for over 20 years, maybe 30 years even. So they had a long time before they actually got to retirement age. They wanted to sit down, they wanted to put together a plan. They took advantage of one of our offers that we did here on the show, and they came in and we put together a comprehensive plan for them. But 25 years from retirement roughly, so they don't really need a comprehensive retirement strategy. They were largely invested in Vanguard growth index funds. They were paying very low expenses, a little under 1% a year, and I showed them that they're going to be perfectly fine as long as they continue on the savings pace and they dollar cost average into this growth fund. They're probably going to be perfectly fine, and this was one of those rare circumstances that they may not even need Social Security benefits if they stay on this savings pace and continue to invest and dollar cost average. And I said, we can probably do as good, maybe not even much better than what you're currently doing as far as investing in these index funds over long-term growth periods like you have. But if you want somebody to sit down with and review your plan and review your allocations every 3 or 4 months, and that gives you peace of mind, then maybe it's worth paying an extra 0.5% a year to have a team behind you and somebody to meet with. We would be sitting down with him, and that would cost him because our time is valuable. And so paying an extra 1% or 0.5% a year for him was something that was worth it. And not just for him, because he said, Casey, this seems like a lot that I'm managing. This is nearly $750,000. We're not even making $100,000 a year. This is a lot of money. We would like to have somebody to sit down with and review this with. It'd give me peace of mind. His spouse also said, it's not just about that for me. It's about knowing that if something happens to my husband, I've got somebody to rely on that can step into his shoes and take over so that I don't have to completely rebuild this plan and understand it from the ground up. So it's all about the actual value that you're receiving. Are they just investing those dollars for you and you see them once a year for a rebalance? Or are they doing comprehensive planning and taking care of your income strategy, your tax strategy, your healthcare strategy, your estate strategy, your inflation strategy, your emergency strategy, and putting that all into a plan that you can understand?
Boy, isn't that the truth? And if you'd like to have that opportunity, maybe you need that second look, here is your chance. For the next 10 people who call right now, Casey and the team will sit down and make a time on their calendar to give you a complimentary financial review of your entire financial and retirement plan. It's an opportunity for you to learn more about what your money is doing and what it could be doing for you so that you can make the very best decisions for you and your family moving forward. So I invite you to be one of the next 10 people to pick up the phone right now and call 482-9559. Casey and the team at Howard Bailey will make time on their calendar to visit with you and give you your very own purpose-based retirement. Now, our question of the day: what is another name for high-yield bonds? Is that a junk bond, an investment-grade bond, municipal bonds, treasury bonds? Casey has the answer and more when we come back.
You don't walk into a doctor's office for some blanket prescription for whatever ails you. You expect individualized attention, a doctor who listens, and a treatment prescribed to meet your specific need. When it comes to your financial future, why expect anything less? If you would like an independent checkup from an independent advisor with access to hundreds of possible solutions to help you meet your goals, contact us today.
You need a plan for retirement to create the lifestyle you've always dreamed of. The first step is to tune into the Purpose-Based Retirement Radio Hour with your hosts, Casey Weade and Marshall Johnson, every Saturday morning at 11 and Sunday afternoon at 1 on 1190 WOWO and 107.5 FM.
Going into the break, we asked you our question of the day, and it is, what is a junk bond? What's another word for, I just gave it away, Casey, what's another name for a high-yield bond? And I think we now know it is.
Well, thanks, Lee. You gave away the secret, and now you really took away all my thunder. But yes, the answer is junk bond, and you may be surprised to find that a high-yield bond sounds very attractive. Nobody ever wants to buy junk. However, more and more people are buying junk inside of their portfolios rather than having an investment grade bond. Now they're owning higher and higher risk bonds, or dumpster diving for yield, as I might call it. And you may pay attention if you've got parents that are near retirement. If you're near retirement, you may find that portfolio managers, investment managers, financial advisors seeking higher and higher yields in this lower interest rate environment are taking on greater and greater risk by buying high yield bond funds, or also known as junk bond funds, because they are higher risk and they act much like an equity equity. I have people that are coming into my office today saying, look at this municipal bond fund that I have. It's yielding 5-6% a year. In this low interest rate environment, that is a high yield bond fund. That's a junk bond fund. We go back and we look at how it did during 2008, and we find that it lost as much as many equity funds lost during 2008. And people think that they're buying bonds. People think that they're buying fixed income instruments that are going to offer greater and greater safety than they might find in the equity markets, and that's not necessarily true because of risk and due to interest rates. And that's one of those things that risk has to do with when it comes to a bond is default risk. The risk that bond will default and the issuer won't be able to make its claim. However, we also have a couple other types of interest rate risk. One of those is the price of the fluctuation of the bonds that you're buying today. We're going to talk about that. And then we're also going to discuss how sitting in cash or sitting around and waiting for interest rates to rise might be the secondary cost of interest rate risk today. First, I want to take a look back throughout the history of interest rates going all the way back to 1800s. Now, from 1800 to 2009, we can see this roller coaster ride of interest rates, with the average interest rate being paid on a 10-year bond being 5% per year. And as we find ourselves where we're at today is closer to 1.5%, less than 2% a year for a 10-year bond, a place we've never before seen. And if we've never been there before, that means we may see things in the bond market that we've never before seen as well. One of the things we have seen, though, is we've seen interest rates rise and fall in cycles. And as we're now in this period of time where we're in one of the lowest interest rate environments in history, might the next 20 or 30 years be a rising interest rate environment like we haven't seen for at least 30 or 40 years. And we need to understand the relationship between individual bonds and bond funds. And I think this is one of the most confusing things for individuals when it comes to bonds, Lee, is to really understand the relationship between individual bonds and bond funds, because they work very differently in different type of interest rate environments. For instance, in a falling interest rate environment, we see something that's relatively static, right? They are both benefiting, whether we own a bond fund or an individual bond. As interest rates fall, bond prices rise, and we benefit from that. We collect our income or our coupon payments from those bond issuers, and we get back our original investment. We might even get more if we sell it as interest rates are falling and bond prices are rising, meaning that we're benefiting from both income and price appreciation, or total return is more than the income return. In a flat interest rate environment where we don't see interest rates rising for a period of time, now we're going to expect that those bond funds actually stay relatively flat in price, and we collect our gains in the form of income. So total return equals income. The same thing bodes true for individual bonds. But in a rising interest rate environment like you've probably never experienced during your lifetime, we see something totally different. In a bond fund, as interest rates rise, bond prices fall, and the price of that bond fund itself falls. We can collect our income, but the price return is negative. So that means our total return is less than our income return. On the inverse, we see an individual bond in a rising interest rate environment. We get back our original investment. That price does not change, and our income equals our total return. Now, we've actually seen rising interest rate environments in the past, but it's been quite some time. From 1950 to 1980, we saw a rising interest rate environment where the average coupon payment for a 10-year Treasury was a little over 5.5% a year. But because bond prices were falling, the investor only averaged a 2.2% total return over that 30-year period. The following 30-year period, we saw a falling interest rate environment. This is one you're probably familiar with. Now we see 11.3% in total return and around a 6% average coupon payment. Now you're thinking to yourself, I'll just wait then if interest rates are going to rise. I'll sit on my hands, I'll sit on my cash, I'll sit on my short-term CDs and wait on interest rates to rise and better opportunities. And I'm going to share with you what it'll take those interest rates to increase and at what pace in order for that to be the best decision for your portfolio. First, we're going to take a look at a 5-year interest rate, and that's 3% today. So we could get about 3% for a 5-year fixed rate and take $100,000 and put it in that 3% a year. At the end of 5 years, it's worth $115,927. Or we could go out and we could buy a 1-year CD today. The average of the 5 top CD rates across the country for one-year CDs is 1.24%. That $100,000 would turn into $111,700 at an interest rate increase of 0.5% a year, which would be quite dramatic and very devastating to our economy. And what if we increased at 0.75% a year? If we increased at almost 1% a year, we would still be underwater at the end of year 5, having $114,000 versus $116,000 in our 3% fixed rate. So what's the cost of waiting? Let's say we're like Japan and we see no interest rate increase for the next 5 years. It could cost you $10,000 in lost interest over the next 5 years on $100,000. What if it's $1 million? What if it's $500,000 that you have in that portfolio? Just multiply those numbers by that amount. A 0.5% annual increase would cost us $4,200 in lost interest, $1,500 in lost interest at 0.75%, and at a dramatic 1% annual increase, meaning that in 5 years we can get a 5% paying CD for just a 1-year term. Finally, we get ahead of the ball, and we're only ahead of the ball by about $1,300. So here's some things for you to consider. 1, what type of interest rate risk do you have today? Do you have default risk? Do you have higher risk bonds than you thought you did inside your portfolio? How much risk are you really taking? Do you own individual bonds or do you own bond funds? Do you have interest rate risk? How much interest rate are you actually being paid today? And will that be enough to overcome any potential increases in the future? Can you eliminate much of this risk? There's a lot of options that are out there today that can pay you a bond-like rate of return with greater degrees of safety than you can get in any bond or any bond fund for that matter. So if you're working with a broker and they're only offering you stocks and bonds, are you really getting to know all of your options? Because there's a lot of options that are out there today that working with a truly independent advisor who has a fiduciary responsibility for your life savings can offer you, and it's up to you to make that decision, but you need to first work with someone who can offer you all those different options. You know, Lee, there's a question I often ask individuals, and it's, have you ever put a nail into the wall with something other than a hammer?
Sure.
And what might that have been?
Any number of things. A pair of vice grips, the heel of my shoe. It just kind of depends.
I've used the shoe, and I've heard that one quite often. I used a speaker once. That speaker no longer works.
Yeah.
You know, and if you would have had a hammer, wouldn't you have used a hammer?
I would have used a hammer.
You know, but if we don't have all those tools, we end up with a lot of inefficiencies within our portfolios. And that's why it pays to work with an independent advisor that can give you the ability to work with options that maybe you didn't have when we looked elsewhere. For instance, I had a gentleman the other day that said, I'm just looking for a CD alternative that gives me some floating rates. Well, we can scour the earth and see what types of options are out there. We were able to provide him with an option that paid him 2.8% today for the next 5 years. And if interest rates increased, he was able to increase that rate. He couldn't get that at a bank, and he couldn't get it from his broker.
Well, that's all the more reason that you are talking to the right person, the person who has your best interests at heart. And today we have a special offer for the next 10 people who call right now. It's a complimentary review of your entire financial and retirement plan. It's an opportunity to get an education about your money so you can make the best decisions for yourself, your family, and everybody who's depending on you moving forward. So for the next 10 callers, Casey and the team will make some time on the calendar to sit down, visit with you, review your situation, and give you your very own purpose-based retirement. We hope you'll call now at 482-9559. We also invite you to learn more about Howard Bailey Financial by visiting the website. You'll find it at howardbailey.com. You can also email any questions you might have to Casey at info@howardbailey.com. And we may, who knows, feature your question on a future broadcast. And there's a new version of Casey's book available online as well, the 2017 Guide to a Retirement Efficiency for the Purpose-Based Retirement. It's available for pre-order now at howardbailey.com. We'll see you next time around. Take good care.